All right. Hello, everybody. This is Jason Fierno with the Mining Misfits. The Mining Misfits are a curated group of industry leaders who've come together to, who are really passionate about making the industry better and more sustainable for everybody. And today, I'm really excited to be joined by Paul Nielson. I've known Paul for a while, haven't talked to him in a minute. So I think there's going to be some catching up to do, which is great. So Paul is currently the principal head of development portfolio at Waterton Global Resource Management. And prior to this, Paul spent time with AMEC Foster Wheeler as a project manager, operations director. He was a commissioning engineer, metallurgical engineer. So really a diverse array of expertise and experience. So really excited to have you here today, Paul.
Yeah, you bet, man. Glad to be here.
Yeah, so let's jump right into it because I'm super curious. So when we knew each other in a previous life, you were living in BC. Yeah. You were working for a major EPCM firm. Now, fast forward a handful of years, you're hanging out in Ontario, working and playing in the private equity space. So let's talk about that a little bit.
So what the heck happened, right? Yeah. So look, right? I've always been an itchy feet person. I was at AMEC and successor companies for like 13 years. But if you look at what I did there, I never did the same job for more than 3.5. And 3.5 was a long haul for me in that. Just because I like variety, I like doing lots of different things in lots of different places. That's part of what attracts people to EPCM, right? So, sure. I had a lot of different roles, and actually before I joined Waterton, I worked for Ausenco for just shy of a year, which is actually hugely influential to how I think about projects as well. So there's lots of good stuff to talk about that later. And ultimately, Waterton and I started talking in late 2016, and they convinced me to move me and my family across the country to lead the development portfolio. So Waterton's a series of private equity funds that essentially have a mandate to invest counter-cyclically in the mining industry. Our industry does a lot of really stupid things. No, genuinely, like
no, so true. It's sorry, man. It just comes funny because I say that all the time, and but it's so right. So yeah, sorry for interrupting.
No, it's all good. So many of those things are structural, right? Like, when metal price is going up, investors demand that companies grow. And show them growth of cash flow, growth of production, growth of all these things. And that cycle can be like 10 years on the upswing. And then for 10 years on the downswing, metal prices falling, revenues falling, your input costs are the same. It's bad business for a long period of time.
So true.
And so what ends up happening is people lever up and stretch, or at least in the last cycle, people levered up and stretched to buy during the growth period. And then what happens during the call it the downside period is that assets get sold for less than they're worth. And so, Waterton's mandate from our investors is to create value by operating counter to that cycle. So when everybody's selling, we're buying. When everybody's buying, we're selling. And in the middle, and there's a huge amount of time in the middle, that's really what I was brought in to do, is we create value on the projects. So all the things that we buy come to us because it was a non-core asset in a major, or it was a cash-strapped junior that ran out of cash, or whatever it happens to be. And then we, step back, take the asset private, and then we give it the time and money it never had, and the attention it never had to actually de-risk it, focus on where the opportunities are, manage the risks, advance it towards whatever the next step for the project is. And so it's our portfolio is largely open pit heap leach Nevada, Southwest US at the very least, but we've got some other things in there. So my job is really to lead that portfolio of projects as they go from whatever stage we got them into the next stages and keep them moving forward.
I love this concept. There's a lot of genius wrapped into this for a variety of different reasons, because you're going against the grain, and I love that, but it also you're watching the cycles because it's cyclical, and it's a sine curve, right? It's up and down, up and down, up and
For
down. Sure. And I love that you guys are taking advantage of that. So I'm going to ask a couple of questions out of interest and curiosity.
Sure.
What are the criteria that you look at when you're making a determination as to whether or not there's a particular asset that you might chase? Like what does attractive look like to you?
That's a really tough question. So I will say that it is a robust conversation involving a lot of disciplines.
Okay.
So basically we're looking for fatal flaws.
Okay. Are
they there? If yes, pass.
Holy shit. Oh, okay. Yeah. Okay.
I know
you're looking for fatal flaws.
No, but really like it's really two things. The valuation has to be attractive. It has to be not irreparably flawed, and we have to see some paths to improve the value. Whether and that can look in a lot of different ways. Sometimes that's just outweighing the marketplace. Sometimes that's de-risking, like advancing the permitting of a project, getting it closer to actually being shovel ready. Sometimes it's taking it through new studies. You know, if a project had a really poor study done by a previous owner, or they missed something. Maybe, you know, one of our projects, if you took size by size recovery, you know, we did some column tests. If you look at them, they looked, you know, from head to tail, there's a certain recovery. But if you broke it into individual size fractions, some of those recoveries were negative. Impossible, right? So there were errors in a data set that we've gone back, diligently worked through, run a whole bunch more tests, and the net result is a substantial boost in recovery because essentially it hadn't gotten the attention it needed before. So we try and identify those opportunities, and then, you know, again, it's portfolio size, it's attractive valuation, this type of thing.
And look, I'm fascinated by this. I could see this being a very dynamic and interesting place to play within the market because it would be ever changing. You talked about it, 3.5 years, you know, one role, and then it's a long haul. So I would imagine in a role like this, you get just all kinds of different stuff thrown at you from day to day.
Yeah, so I'm coming up on my 5th year in this role, which is, and honestly, this is the first role I've ever had where I am not bored by this amount of time. And really that comes from, you know, Waterton is a very hard place to work. And that challenge is just wonderful. All of our principals and partners are not, so our partners are not mining people, they speak dollars. Okay. So the discipline that we have to go through as technical people and as project people in advancing these things is to convert everything to a common language. So we talk in dollars, everything. So it's no good for me to say to our investment committee that, hey, we think we can spend $2 million on a metallurgical program that will increase recovery by 2%. They'll say, you're wasting our time, get the hell out of here, right? But I can say,
what's the impact? Yep.
Yeah, exactly. If I say I want to spend $2 million to make $10 million, they're like, okay, that makes sense. And look, that's the way we underwrite things, and that's the way we think about things. What happens if I do this? What happens if I don't do this? How good could it be? How bad could it be? What's the range we're playing in? You know, like the fastest way to burn your relationship capital here is to say that this is the way something's done because this is the way something's done, as opposed to this is the way I'm recommending to do it for this specific instance on this specific project because of the risks and opportunities in front of us here. You know, this is we have a culture of really, really healthy challenge, meaning everybody is a skeptic and you have to be able to get everybody over the line. And if you can, then it's a good idea. And if you can't, then you need to rethink your idea. So it's a pretty fun environment that way.
Yeah, I love that mentality. That constant challenge, you know, in a constructive way, right? In a constructive way, not, usually, hey, you're an idiot. There's going to be that. But you know, the picture that you're painting in my mind is very productive in the sense of having some constructive conflict, you know, a safe space to say, well, I don't really understand that. Can you explain that to me in a different way so that it makes sense and really, I would say, trying to poke holes in it,
For sure.
to see if the damn thing holds water. But I think if you can do that in a construct way, there's a lot of power in that.
Oh, for sure. And it's the way we work with our external service providers too. I mean, we are the toughest. We are a demanding client because they'll provide a piece of work and then we'll just see if we can kick it until it dies. And if it doesn't, then it's good.
Yeah. Okay. So how do you bridge the skill set that you took from, working in operations, working in projects, being on the commissioning side? I mean, that's all very different than private equity. So what does your team look like?
So we have a bunch of, I don't want to pull back the curtain too much, but we have in-house technical people. So we've got a bunch of geologists, a bunch of mining engineers, metallurgists, financial analysts, project managers, projects people, project controls functions, all that within, what we do, as well as having an integrated environmental permitting team. We have obviously legal, finance, and then investment functions. So we're a fully integrated shop. Obviously, we can't do everything ourselves, so we do use a lot of external service providers. But the way we work is we force all of our technical people and people to sit in the same room, and a lot of the value that gets created is when the geologist and the mining engineer are talking about how we're going to optimize this particular project, and the metallurgist overhears that actually what you guys are saying is nonsense from my discipline. I'm going to inject myself into this conversation. The three of us are going to hammer it out, and everybody understands everyone better. And there's a ton of value. You know this as well as everybody. There's a ton of value that slips between the silo cracks in our industry. That there's so much value that spans silos, and the only way to get at it is to integrate those silos.
It's genius, man. I love it. I love it. I love it. And it's particularly exciting for me because I'm thinking about the conversation that I had yesterday. I mean, I'm participating in a basically an assessment, a fatal flaw analysis for a client. And we're looking at the project, and you've got an EPCM that's in one silo. You've got the water management / tailings in a silo. You've got the mining folks in a silo, and none of them are talking to each other. And there's gaps all over the place because you're not taking the metallurgist, sticking them next to the geologist, next to the project controls person, next to the project manager, and saying, well, wait a minute, this doesn't make sense. And I love that you guys force that, because there's a ton of value in that.
But it's tough, right? Because we can only do it because we're small. Like with scale comes complexity, right? Efficiency and assurance are kind of opposite ends of the same continuum. And it's like mining projects are world leading in their complexity. Simply because every deposit has unique geology, which has impacts on geotechnical engineering, on hydrology, on metallurgy, which has impacts on process design, which has impacts in permitting, which has impacts, on the environmental design, which has all these things. It gets this massive multidisciplinary complexity. So there's nobody who is alive who can look at that and go, right, I got this. Bullshit. Like, it's totally. It involves so much technical expertise. It's very hard to find people who are interested in looking over their silo to the other one. It's also very hard to find people who are interested in integrating those things and good at it. Like it's not, as much as it's nice to say we should just smash together those silos, it's really, really, really hard to do in practical terms. So it's not like it's not like it's an easy thing.
No, it wouldn't be. And I can really relate to this. Where I like to play is in the prime contract space, where you've got an owner that has a bunch of money in a deposit and a contractor that has, people and systems. But they speak two different languages. Owners speak a different language than contractors. And that goes down into sub-disciplines and everything. So I love bringing those two together and integrating them and collaborating. And it's really, my skill set around facilitating that collaboration that makes me good at what I'm doing. Not because I know a ton about mining or I know a ton about projects. I mean, I do, but it's really that integration, that facilitation, that collaboration. So are there any things that you use or that you do to, foster an environment that's conducive for that?
Well, I think the most important thing is empathy. Part of the reason I look at, so I learned from a bunch of really spectacular people earlier in my career in doing different things in different places. And, like after I had worked in commissioning, I understood design engineering a lot better. Sure. Because I had felt the pain of trying to make it work in the field, right? And likewise, once I had worked in proposal development and business development, I learned an awful lot about how you need to cut the cloth to suit. You can't have, the triple constraint to project management is quality, time, and cost. You can't have all three. You got to give on one to move in the other directions, right? So I learned an awful lot about that and how the scope and communication is actually one of the key critical things, and that's influenced me in the rest of my career. All these things just come to cross-functional empathy. Now that I sit on the owner's side, I understand. So many owners look at like an EPCM contract and go, right, I want a pain share, gain share on top of that, right? That pain share, like an EPCM company, in bad times, their margins are probably 5-7% net. In great times, there may be 15% at the absolute, best contract imaginable, top end, right? So for every dollar the owner is spending, the EPCM company is seeing between 5 and 15 cents of profit. Like, so you want them to give up a meaningful dollar for an overrun. All they can really do without blowing their brains out is a nickel or a dime, right? And so now as an owner, I understand that that's the world they live in. So it affects how I engage them. It affects how we work together, because, I know you're a huge fan of in contracting approaches, finding win-wins. It's such hard work, but it is the only way to actually move forward and build a team that can succeed. You have to have the right experience, obviously. You have to have the right mentality of the people, and that comes to team construction. But so many times, like when I worked in EPCM, an owner would give us a contract. We'd talk with their team, and we'd all align, and everyone would figure everything out. And then they'd hand us their standard contract, which basically says, do all these things that are directly counter to our interest, and directly, like what? Like
it's insane.
Yeah, and our industry went through 10 years of it, right?
I think we're still in it, bro. I really do.
Yeah,
we really do.
We're getting there. We're getting there.
Yeah, I'm an optimist. Don't get me wrong. But I'm also a realist, and the good news, the great news, is that you and I can sit down and have a conversation like this, and it'll perk people's interest, and they'll say, yeah, that's actually right. So that we're having dialogue, we're having conversations. There's forums to do that. I know you're a big proponent of CIM and a supporter, so am I. I mean, they're up to great things. There's a lot of really good stuff and conversations that are happening, as well as what I've seen is there are progressive owners out there who are looking back at statistics saying, this sucks. Like, I don't want to be that statistic. We got to do something different here. What can we do? Which leads me to, I think, what could be a very interesting dialogue and conversation is around the different facets or the different groups within project delivery. So you talk about, financiers, you talk about owners, you talk about, contractors or service providers. What is the lens of a financier within our marketplace?
So financiers, this is going to be hard to believe, they just want return. Yeah, well, I know it shouldn't come as a surprise, but projects people and service providers and owners don't really understand what that actually means. To the financier means it like somebody looking to fund a project is looking at, I'm putting money in and I want money out. Risk equivalent, right? And so when they're looking to protect their downside. They're looking to maximize their upside. And if that means, and it becomes an interesting dance for the different forms of capital and different ways an owner can raise money, the different people that they'll engage with, whether it's debt side, whether it's an equity raise, whether it's a metal stream, whether it's selling an offtake. All of these things affect the strategy of your project. And I don't think service providers and owners actually understand that very well. And the best example I can give is from own negotiations that I've been involved in. Let's take a hypothetical project, give it $100 million sticker price, say it's EPCM. And say you were to borrow the whole thing, just to say, because let's go hypothetical. So you're borrowing $100 million, and your lenders look at the industry's track record and say, so you're going to blow this out by at least 30%. So you're not borrowing 100, you're borrowing 130, and there's still risk in this. So you're getting it at a pretty poor rate. Versus an EPC type delivery model where they'll say, right, $100 million, the cost overrun risk is transferred to your contractor. It doesn't sit with me. Therefore, your cost of capital is lower. So you're getting $100 million at a lower cost of capital versus $130 million at a high cost of capital. Those are really different projects in how you think about, from an owner's side or a service provider standpoint, how you're going to execute that project. All this, those are not the same animal anymore. And people, there's a lot of naivety in our industry that says, right, this is what the project is. The first question you have to answer for every single project is, what can we afford? And then you build your business model back from what can I afford? Because if you have, if you're a junior with a $100 million market cap and you have a $5 billion project to execute, I'm sorry, you don't have a project because you can't afford a $5 billion project. You just can't. And so the philosophy about how you get your project designed, what bells and whistles you pay for, like the way that a major and a very sophisticated long life asset, something like a BHP would be interested in. The way you design a BHP project that is expected to have a 50 to 100-year mine life is very, very different from how you design a gold project that's expected to have an 8-year mine life. Like, absolutely, man. At the end of 8 years, your project should be falling down. And if it's still making money, you can invest some more money to keep it from falling down. But, that's what it is. And those things should trickle down to the design approach taken in the engineering and the procurement approach and the construction approach and on and on and on and on.
Yeah, and I'm guessing that you took a lot of that from your Asinco days, or some of that emanates from your Asinco days and the way that they look at building, because it's different than a lot of others. It really is. But I understand what you're saying, and there's a lot of merit in that. If you take BHP's Jensen project, which has spent $500 million already, and they're I don't know how, 4 years from production, and then you take one of the juniors that has an asset up in the Golden Triangle, it's a totally different animal. So I think that's a really fair point.
And that's the thing, like it really, it's been impressed on me working here. But it really is, you have to look at the specific circumstances of your project and of what you're doing and craft the right strategy for that thing. And really step back in the context of that strategy. How do people want to operate? How do they make money? How do we make this a win for everybody? What needs to be done? Where are the risks? All that kind of stuff. When people talk about just going through the stage gates, and this for me is like one of the biggest pickles to unpack. Is if you're a major and you have a heap leach project somewhere, small heap leach project, but great grade, say. And you also have, another project that involves a honkin' big mill. How do you decide where you're putting the capital on an equal risk basis? It's an impossible challenge, because one way to do it would be to say, right, we have a given gate that says, okay, for a project coming out of pre-fees, these are the things you need to have in place and blah, 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 blah. And often those things can be pretty prescriptive. But what if the prescription doesn't make any sense for your project? You have to have those dialogues and say, like, look, this is nonsense in this context. This is a waste of time. It doesn't, you know, because if you look at how bad something could be and how good something could be, and neither of those things change your decision, then don't waste any time on it. Right? Like if you're looking at, for example, like a recovery rate, and you know there's a risk range between, say, 75% recovery and 80% recovery, and you could do a bunch more work to answer that question, and it's going to slow you down to do that. But if the answer is at 75% recovery, you're still building your project, just build your bloody project.
Yeah, I totally agree, man. Stop tinkering with it. You know, 81% isn't gonna, you know, move the needle if you spend 6 months trying to get that extra 1 or 2%.
Yep.
I could take you with me, man. I could take you with me and have conversations with owners, because the reality is that I think there are a limited number of individuals who are thinking like this and think like that. It reminds me of something that one of my mentors used to say. He used to say, one size fits none. There's no such thing 100%. As one size fits all. One size fits none. You have to look at the specifics, the circumstance, the project, the capital, the geography, the political situation, the people. I mean, the list is endless, right? But you can't just take a stage gate project off the shelf and say, well, wait a minute, in 2B we do this, and if we don't do this, then we're not going to go forward. It's like bullshit, man. Like, think about what you're up against.
But the experience and the quality of the team you need to have in order to really question, and you know, we talked about the complexity of all these different technical disciplines. The quality of team that you have to handicap and manage all that and make the right decisions across all those disciplines is exceptionally hard. Right? Like it's not like people haven't thought of this stuff. It's just really hard to execute on. And partly, you know, one of the structural things that comes from the up and down cycles in our industry is that people leave. Mm-hmm. People lose their jobs, and then, like rational people, they go find another industry and another job where they're not going to lose their job. Mm-hmm. And you know, so you know, the capacity, you know, the industry flexes from this many people to that many people, then back to this, then back to that. Well, the truth is, that's where your expertise is, and then you're scaling everything, right? And scaling is hard.
It's really hard. It's really hard. I have a flashback as you're, you know, contracting, expanding. You're so right, though. I mean, I remember working for a major gold mining company, you know, during the GFC in 2008. I felt like we were in the eye of a tornado because, you know, gold was going, you know, straight up almost. And we wanted to build projects because why not? Let's put more ounces into the portfolio. So we were going out, growing, and we were grabbing anybody with a heartbeat. You know, you got a pulse? Okay, I'll train you up, you know, and then things started to go the other way in 12 and 13. We go back to this contraction, and you just shed all of that excess weight. But the point that I'm making is, I think, the same point that you are, is it's that nucleus, it's that core where the real expertise resides. And I think the core is getting smaller. What's your perception of that?
Well, so when I worked in engineering, we had an exceptionally awesome, talented, experienced team. And one of the core challenges was that some of our competition had, like, candidly, less experienced people. Sure. So it was a double-edged sword, right? On one hand, you've got the experience to be able to do it well. On the other hand, experienced people cost more money, so you're less price competitive, right? And a lot of buyers in mining buy on price. You know, like if you look at the capex of a project, if 10% is EPCM and 10% of the EPCM company's contract is margin, EPCM margin is 1% of the total capital, and that's where a lot of owners will grind the EPCM company. Like, I want a 10% haircut on rates, and put a ton of time into that just empower them to shrink the pie, man. Like,
You're so right, though, and you say it a lot more eloquently than I do, and I appreciate that. So I'll probably steal some of your language, but you're exactly right. It's that 1%. It's the 1% that so many, you said, buyers in the mining industry chase. It's insane, man. It's insane.
But it's because it's easy.
It's true.
It's one of the single biggest contracts. Like when you're letting an EPCM contract, it's a big contract.
Yeah.
So big dollars, then you're going to squeeze on those dollars. Like I get it. It's part of a price negotiation. But like, you know, the philosophy that the finance industry takes. And if you look at the service, like engineers and technical people, particularly projects, you know, anybody involved in the project supply chain, I actually think we have a massive inferiority complex for how much we charge for the value we deliver. If you look at lawyers, accountants, bankers, they charge for their value. Engineers and technical people, project delivery people do not charge for their value, which is busted ass in a separate topic. But if you look at the philosophies that are taken in the world of finance with investment bankers, with accountants and lawyers, often the comp mechanism is you are paid handsomely for value, like from a pool of money that otherwise would not have been there. So if you're not involved, this money isn't created. If you are, you get some of it. Basically, you create value, you're paid from the value, which is a higher risk model, because if you don't create value, you get paid squat. And you know, like if you look, for example, if you got a banker who's paid solely by success fee, then if they have no success, they have no fee. And that's tough. But the flip side to that is you can make spectacular margins if you're successful and good at what you do. Whereas if you just charge by the hour, you're not empowered, you know, essentially your downside is utterly protected, but the upside's not there either. So I think that, you know, back to the thing where I'm sure we have the same hymn book that we sing from regularly, is just find the win-wins, find ways to pay people transformational margins by good performance. Like if I was delivering a project that had a $200 million capital cost, I'd say to the entire team, right, every dollar under that target price, a big chunk of it, like a double-digit percentage of that, feeds a bonus pool. And of that bonus pool, a bunch of it, 50% of it, can go to the people on the project. So like pocket. In your pocket, you want to come up, like find a good way to knock down the bulk quantities on a project and save me money. Yeah, man, keep a share.
100%. Because I was spending it otherwise. Yeah.
Because I was going to spend it, and bulk quantities, like, you know, if you're spending on instrumentation, on valves, on tagged equipment, on process gear, on mining gear, those things are your cash flow, right? I'm not skimping a dime on those things. So, you know, when you go into a value engineering phase, if someone's trying to squeeze the equipment, they're totally wrong-headed. The equipment is where you spend the money. But like steel provides me no value as an owner. Concrete provides me no value. Concrete.
Exactly.
No value, zero value. It's just a big money pit. And the team's job should be to design a way to mitigate the size of that money pit.
I love it. So true. So true. And fundamentally, you know, the idea of value creation and being compensated on the basis of value is something that I coach my consulting clients on all the time. It's like, if you're trading time for money, it's a race to the bottom. Yeah. And I think the point that you've made is exactly right. Like if you look at a lawyer's fee, $1,000 an hour, and then a project manager, which was like $175 an hour, which is insane. You know, it's like, well, what? It's like the value is not there. You're paying someone $175 an hour to build you a $5 billion project. Don't you think, you know, maybe if they were making a little bit more money, they might actually, you know, try a little harder? And I'm not saying that they're not trying hard. What I'm saying is that the value proposition is not the way that EPCM companies sell themselves at all. So the idea value creation is huge.
Well, and to go back to that hypothetical example, say it's a $200 million project, EPCM contract is 20 million bucks. 2 million of that is margin, right? If they find a way to deliver it for 180, there's $20 million. Let's say we take 25% of that and put it into a pool of bonus money. So of that, now there's $5 million that can be distributed to the company and to the team. Say half of that goes to the company. Your margins just doubled. And your team is friggin' thrilled in that hypothetical example.
Yeah. Mama's getting a new car.
Exactly. Like, and as an owner, that has cost me nothing. Zero, like actually zero, because before I was going to spend $200 million and now I'm spending 185. I'm still thrilled.
And I got a happy contractor too, and a happy team.
Like, over
what's
the moon.
Culture of that? Over the moon. Absolutely.
Well, and you want people to do a good job, like amidst the backdrop of a skills shortage, right? Amidst the backdrop of a skills shortage and we're in early days into this CapEx cycle, right? Like, remember the last cycle, there were a whole bunch of mines that didn't get built because companies couldn't get truck tires. We're not there yet. There's a long way till we're there, right? And
I remember that.
Yeah. And so if you're an owner in that environment, you want to be an attractive client. You want to be somebody that your service providers are thrilled to work with because you're treated reasonably. You can make more money. Like, like if you're an engineering service provider or, a resource estimation group or, a contract procurement group, you have all the work you can handle right now. You get to pick and choose your clients. So your clients better, like as a client, you have to think about what do I do to position myself to be somebody that I can get the best team working for me.
So true. It's absolutely 100%. You're speaking my language, man. I totally agree with you. I down to every fiber in my body. I wish everybody else thought like that too, but you're speaking a lot of truth, and I appreciate that for sure.
Get lucky.
Well, no, it's one of those things where you spent enough time in the industry and you're an inquisitive guy that is like, well, why are we doing that? Well, that doesn't make sense. What if we did something different? And I think that's probably, that mentality plays really well into the job that you've got right now in the company that you work for. So I think that
for sure,
that's perfect.
Well, and look, I like ultimately the philosophy of a project team, is to the sign over your shoulder there. It's as much do epic shit as don't do stupid shit. And so much of the things we're just in the habit of doing as an industry are, like, really, when you step back and challenge them, they're pretty stupid.
You said it to begin with, man, and it made me laugh because it's true.
And it's not like it's going to get easier. Like, if you look at what the next 5, 10, 20 years of our industry look like, easy deposits are done. So you're either going to places where you have big ESG risk, whether that's governmental risk, environmental risk, social risk, however you want to define that, or you're going for more challenging deposits, either because they're lower grade close to surface or higher grade deep underground, so you spend a fortune to get down to get to them. All of those things, like the most conservative electrification forecast for the world, there's nowhere close to enough metal supply.
No, not even.
So
figure that one out for me, right?
Well, no, and so you're starting, like, there's an interview I read not too long ago with one of the co-founders of Tesla. Turns out Musk isn't the only guy. There's a lot of other smart people behind that one. He was talking about how a lot of the other car companies are saying, yeah, we're committing to electric and all this. But they haven't gone far enough down the supply chain. Like, I think you're going to see every car company do what Japanese steelmakers have been doing for years, right? Like, it was
so true.
It was very, very common, and has been for a long time, for Japanese companies to integrate the whole supply chain and own copper mines that had a moly byproduct just so they could secure the moly, right? Like, I worked at Huckleberry in BC, and Mitsubishi had a stake in that just so they could have the moly.
Yeah. For good reason too. It makes a lot of sense.
Because they need it. And
yeah.
And so I think you're going to see car manufacturers get in bed with mine operators in JVs in exactly the same way. And I think you're going to see a lot more integration of that kind of supply chain, because, what happens every cycle in mining is projects that were uneconomic in the last cycle. They're like, look, you find new projects that are great, but the pace of exploration, spend, and discovery has been pretty poor across most commodities, right? So you're left with, it's going to take forever, and the only things available were the projects that weren't economic last cycle, and with a new pricing environment, they will be, and those get built, and it's tough. That reinforces the same cyclicality we're talking about, right? These are structural challenges that aren't easily solved.
No, not easily solved, but I think to those that are educated, you can see the cycle, and because you can see the cycle and what's likely going to happen, you can react or not react. You can respond accordingly, because I don't think people should react. I think they should respond. But there are trends, and they are cyclical. It's not the first time we've seen this stuff.
Oh, it's been happening for a long time.
Right, in a long time.
Like,
well,
I remember building a project. Sort of, I was involved in the EPCM and commissioning of a project, and this was back in the early 2000s, and the gold price ran pretty hard, from like $200 to like $350, and the owner in the midst of this project knocked 6 months off the schedule, and it's just like, hustle, go, and and we did the best we could, right? But and you look at that's a 50% move, right? And people today, you look at it like, most of my company's portfolio was constructed around between $1,000 and $1,200 gold. Now spot price is 50% higher than that,
right.
and that run from $200 gold to $300 gold ended at around $2,000 gold, right?
Right.
And that was before the electrification thesis and the fact that the world has decided we're going to stop burning dinosaurs. It's going to take a long time to get there, right? It's not simple stuff, and commodity price, people underestimate how much commodity price can move and how much that movement will affect the projects that are going.
Oh yeah, the ripple effect is ginormous, absolutely ginormous. But with that, I want to ask you, like, we could talk all day about this stuff, but I really want to ask you, in your opinion, the question I ask everybody, which is, where do you think the mining industry is going to be in 10 years? That's the first part of it. And then the second part is, where do you want to see it?
So I would love to see our industry stop doing stupid things.
You and I both.
But where like, and look, capital markets are really sour on the mining industry because mining has destroyed a ton of value. It has destroyed a ton of capital. So if you're an investor, you look at the sector and go, this isn't a long-term investment. This is a swing trade. I'll get in when things are really cheap and I can see they're going up. And then when we get near a top, I'm going, and that exacerbates the cyclical problem. I would love to see diversification across commodities. Part of the challenge is investors want a clear, like, if you got a copper thesis, I think copper is going to the moon. You want to put your money in a copper company. There aren't that many pure copper companies. Usually they're diversified base metal companies. You can already see the gold companies are talking about this, right? That you can already see they're talking about the attractive projects for a gold major are big copper porphyries with a gold credit. And they can get in bed with a base metal producer, because a copper company thinks about a project differently than a gold company does. They think about, the mine life divided by the payback period of the project. And they want that to be as big a number as possible, because that tells you how many up and down cycles that operating mine is going to endure, because they know, yeah, for sure. And they know that in the good times, they're going to make a lot of money, and in the bad times, they're barely going to break even. And it's really, really tough. So I would like to see that for sure. I would also love the industry stand up for itself a little bit more. I have frequent discussions with a lot of people in my life. Like, everybody thinks mining is dirty, right? Nobody wants a mine in their backyard. And I get it. Like, when mining screws up, it's an eternal monument to failure.
Yep.
Right. It just sits there. People drive by it. You know, it's bad news. And like, I come from BC, the Britannia mine, acid rock drainage disaster there is, you know, front of people's minds. You know, when the industry screws up, it screws up bad. So I really get that. But the truth is, you need it. The modern world we live in, like, if you were to have asked me 10 years ago what commodity was going to be the toughest thing to source in our modern world, would you have said tin? Right. Like,
no, for sure.
If you had, you'd be like, you know, coming up to visit me on a private yacht. Like
true.
But the truth is, there's no, you know, materials where there is no known replacement. You need tin just to solder. We don't use lead solder anymore. We use tin. It's got a low melting point. It works. You don't use a lot of it by any given user, so it doesn't actually affect the input cost and output cost of their product. You know, you use it on circuit boards for solder. But if everything has an Internet of Things, the demand for tin is off the bloody charts. And so, you know, people, you know, how many people who are just generalists pick up their phone and go like, you know, there's $500 of tin in this. No, nobody thinks like that. Nobody thinks of the supply chain start to finish, and mining is on sort of the gross end of the supply chain. I wish people understood that better. And where do I think the industry is going to be in 10 years? I think the industry will be, it always grows. Growth is inevitable in every business, you know, because new ideas come in, new people are successful. I think our industry, I would like to see companies do things that are smarter over the long term, but that's a very, very hard thing to do. It takes tremendous discipline, and you basically have to tell money to go get lost, which is a very hard thing to do.
It is a hard thing to do. It is a hard thing to do. But you're right. There's a lot of quarter by quarter decisions that get made within our industry, not longer term in many instances anyway.
Yep, for sure. But that's not unique to our business. That's just capital markets. Because the reality is, you know, in public capital markets, you know, your mining companies aren't just competing with mining companies. They're competing with Joe's Widget Factory that has really predictable operating parameters, set input costs. If input costs go up, you jack the output costs. Joe's Widget Factory does not have too much worry. Like, supply chain disruptions happen, yes, but Joe's Widget Factory isn't worried about his revenue dropping 50% or 75%, or, you know, the price of widgets going 10x. That's not part of his world, and that's the capital market you're competing in. You know, if somebody else can, you know, 10 years from discovery to production, that's a really long time.
It is a long time.
So as much as our industry does stupid things, they're rational stupid things, unfortunately, that come from the structural issues that are behind it. And I don't think, look, if I had a magic solve, I would be much wealthier than I am.
But I would love to unpack that, though. I mean, there's talking about the structural infrastructure of our industry and the way we're built up, I think, is a conversation in and of itself. But
yeah, for sure.
Look, Paul, I really appreciate the conversation. Tons of wisdom, really great insights, great perspectives. So I really appreciate you taking the time to, you know, have a chat with me today.
Oh, my pleasure.
I think our listeners really enjoy the insights that you shared with us today. So if people want to, I know so. So if people want to chase you down and rub your head, where do they find you?
Best place to hit me is on LinkedIn. You know, I'm there. I've got a profile photo that's a solid 15 years old. I kept my hair short then. So you know, I've looked like I was in my mid 40s since I was 20. So it's legit. I think it holds, but yeah, that's the best place to get me.
All right, brother. Sounds good. And we'll make sure we put all that in the show notes. So thank you, Paul. Really, really appreciate it.
Yeah, you bet.